On this episode, Mitchell England is going to tell us what his predictions are for the next 3, 5, and 10 years in real estate. What is commercial real estate going to do 3 years from now, 5 years from now, and 10 years from now? You have not been able to stop yapping about these predictions for days. My phone is blowing up with text and audio messages of, I am certain this is what's going to happen 3 years from now. I am certain 10 years from now, this is exactly what commercial real estate is going to look like. Mitch, that's a long intro. I know you're excited about this more than any of us. So why don't you start off with your number one prediction?
So first of all, I want to thank you for a total blind setup on that one. That was very, very classy. Hey, I know. I love it. Here's the thing. I think real estate's going to continue to go up in the right. In fact, I think that recent macroeconomic events or just looking into the greater economy, everything points to price appreciation. For example, the war in Iran affects oil prices. I don't know how long that'll take, but oil prices are driving up inflation and prices of everything, and that will translate into hard assets as well. We've seen tariffs. We're still seeing money printing. We're still we're still seeing similar patterns that we've seen in the past with multiple leaders. I think that things are going to get more expensive.
I want to stop and ask you one thing. You said up and to the right, and I think we all believe that real estate will go up and to the right over a long period of time. Real estate it's a long-term game, right? We all believe up and to the right. But over the next 3 years, do you think real estate nationally is going to go up and to the right? Because we have some markets where real estate is going down and to the right. Would that be down to the right? Words.
Down and to the right. So, okay, I don't love predicting other than, my long-term prediction is it goes up to the right. And I think I'm right about that because of just the way our country's run, okay? And it has been run like that for a long time. I mean, look at historically, real estate's done really well. We all know that. Short term, I do think there's some pain in the marketplace. I don't know what that looks like. I think it's going to be bumpy on the, if you're looking from left to right, I think it'll be bumpy. We're starting to see that. 5 to 7 years ago was an interest rate low. Most commercial lending resets in 5 to 7 years. So right now, fast forward to today, we're seeing people reset. If people did not, investors did not factor in, higher interest rate payments, then they're either selling at a loss or they're doing cash in refis or they're giving it back to the bank. We're seeing that. We've talked about that in past episodes.
That has to impact the real estate market. So right now, those loans are resetting. We talked about this on a pretty recent episode. Those loans are resetting. So my question, Mitch, to you and to Travis, what does that do to the real estate market over the next 3, 5, 10 years? Because we're literally coming out of a time that we've never seen. We had record low interest rates, and then we had an increase faster than we've ever seen ever.
Way high. And now yep.
But those loans are resetting. And we talked about there's a lot of people about to get their ass kicked. There's a lot of people that owe a lot of money to banks, and those properties aren't worth, what they were even when they bought them. So what's going to happen in the short term? What's going to happen to those properties? What's going to happen to real estate values? What's going to happen to cash flow over the next 3, 5, 10 years? Just from that scenario alone, that these commercial loans are resetting.
Travis, what about you? Anything intelligent to say?
Yeah, I think it's a dumb question. I think Gabe's question was dumb, and I think Mitch's answers were dumb. No, I think.
Unbelievable.
I would say if I needed more time to think about how I was gonna respond. Yeah.
No, I would say that. I would say it's asset class specific. I mean, I'm in apartments. I'm in mobile home parks. I have one commercial asset that's more sort of mixed use office. Gabe's in triple net industrial, triple net medical. So it's like asking, is real estate going to be a great investment in the next 3 years? It's location specific. We invest in boring areas with stable jobs and stable employment. We're seeing a dichotomy just in how appraisals are happening. We're seeing in mobile home parks, we're seeing parks transact at much higher prices than they're appraising at for refinances. I'm seeing the opposite with multifamily. I'm seeing appraisals on a refinance way higher than they will actually transact on the open market. It's weird. And So I think it does have to do with asset class. I think office is still going to struggle. I think you're going to see a lot of pain. I think there's going to be a bleed off with multifamily over the next few years. I have, 250 units that I'm holding until I see absorption happening. Again, market specific. I own apartments in sort of more stable markets as opposed to the bubbly markets like, Austin and stuff. So maybe it's a cop out answer, but I think mobile home parks are going to continue to do well. Decreasing supply, increasing demand, best affordable housing asset class.
I think that because you guys dick ride mobile home parks all day long, but why is it? Why is it
triple net industrial businesses are doing really well?
Unbelievable.
How is it actually asset class specific? Because all commercial lending, remember, commercial on the lending side is 5 units or above, but commercial lending could be a 5-unit apartment complex, it could be a 50-unit apartment complex, it could be triple net, it could be self-storage, it could be mobile home. All those fucking loans are resetting. If you like what you're hearing so far and you are not making at least $120,000 a year with cash flow real estate or have millions of dollars in equity, come check out our 0 to 100 elite community. The link is below. Check it out.
So location specific, asset specific, that's going to change things slightly. But when you look at mobile home parks, it's the lowest default rate among Fannie Freddie, but we're starting to see trouble in mobile home parks. So yeah, it's a great asset class. Yeah, maybe it matters where you bought it and how you bought it, of course, but it's still seeing trouble. I think every asset class, anything to do with commercial lending, because this is a debt reset or a debt. In other words, yes, resetting from low interest to high interest, anything to do with debt, it's going to affect it. So I do think you're going to see short-term bleeding. And then you'll see absorption. Those assets will trade for lower prices, set a new basis. Somebody will get a good deal, hopefully. And then we'll continue up and to the right. But what does that look like? Is it like that? Something like that. I think you're going to see a little bit of trouble in the short term. In fact, we're already seeing it. That's not even a prediction. We're already seeing it.
I mean, our audio listeners can't see that thing that you're making with your...
No, it was my finger that was up and to the right with a little bit of a low. Anyway,
where
you get the point. It's
none of my business. But hey, I promised our listeners Mitch's prediction. So yes, these loans are resetting. Yeah, there's markets that are frothier than others. There's markets that are in a world of hurt. Some of these large markets that were overbuilt. But genuinely, where do you see, and I know nationally, it doesn't really matter because every market is, really local to itself and that plays a part. But I'm, nationally, we have listeners and we have investors in our mastermind all over the country. Where do you really see, how do you see this, joking aside, how do you see this impacting real estate values and cash flows among all these asset classes and nationally? I'm curious, over the next 3 years, 5 years, 10 years, I mean, are we going to stay pretty flat? There's a lot of markets where it's just staying pretty flat. Prices, aren't changing all that much.
Yeah. I mean, I'd agree with you, Gabe. I think we're going to see flat, potentially negative in some markets over the next 3 years. You've got puts and takes. You've got inflation that is happening, which increases cost of living, which falls through to increased rents. That's a put. A take would be increased expenses. So maybe NOI is treading water. But I think the debt markets are the biggest factor here. I mean, you're going to see maybe more assets hit the market. We've never seen a mobile home park, bank-owned mobile home parks in our deal finding. We have 2 of them we're looking at right now, which is, to Mitch's point, is really interesting. So you might see some more supply and commercial assets hitting the market at low, driving prices down. But at the same time, you're also seeing equity traps. In fact, Mitch and I were just talking about this with one of our parks where we've got several $1 million in equity in this property. We have 7 years left on a note. And we're in the 4% interest rate. So we have a very hard decision to make. Do we tap that equity by refinancing at a higher rate? Or do we just sit on it? Or do we exit the property? But I think overall, there's going to be a lot of puts and takes. But I think generally, nationally, you're going to see flat and you're going to see some of these bigger markets that were bubbly pulling the overall national trend slightly negative.
I agree. I mean, I think in the short term, it's going to be flat, potentially negative. We're already seeing that. In other words, it's going to take some time for absorption to happen for these assets, no matter what asset it is, to trade into for new ownership to come in at a different basis and then continue to grow the asset. That has to happen. We talked about it with a couple investors we know losing or giving back properties to banks. Well, those banks will get rid of that property to somebody else at a different basis, and they'll continue to ideally grow that asset. And that absorption will help stabilize the market. But like a lot of properties were bought 5 to 7 years ago. So that could take a good 3 years for absorption to happen and therefore have a flat market. And then I think we'll continue to see growth. I mean, this is why we talk about looking at real estate in a long-term lens, because in the short term, it can look really choppy, but in the long term, it's gone up into the right, pretty consistently throughout U.S. history. So yeah, 3 years. I think we're in a rough little market. The good news is though, is like, look, there's always deals, no matter what market we bought in the up. When things were going up, we'll buy this year. We'll buy next year. If you stick to the fundamentals, you're always going to find deals, but there are different markets that have different sort of like volume of deals or potential deals. And I do think we're in a better market for finding deals today than we were even 2 or 3 years ago, because it was still pretty hot. And so for investors who want to get out there and follow the fundamentals, right now is a great time. Be the solution for someone in pain, and you can go take down an awesome asset.
And that was really kind of my next question, which you kind of led me right into it. Like, does this create an environment for, experienced investors, but also new investors wanting to get in, where there's actually going to be more opportunity because, maybe someone is just desperate to get out of a property or desperate to get out of the loan, or the bank wants to find a different buyer. And so they're resetting that basis at a lower price point. Do you think this will be, and I don't mean a easier time for someone to get in, but do you think it's a great time for someone to get in because of some of these changes we're seeing in the market with interest rates, with financing, resetting and stuff?
Well, I could jump in on that with my own opinion. Absolutely. Like Mitch said, there's always deals. But when there's pain in the market, that's a fantastic opportunity. And if you can buy a property that has an expanded cap rate, which means basically a lower price, below replacement cost, which you're seeing a lot of that kind of stuff out there. If you can get in with banks, Mitch and I are talking to a bank that's taken a 3-part portfolio back. That's a huge opportunity. If you could get in and make it work at higher rates, like we've seen this. If you can get in to a property, maybe it's a subdued value, but you're getting in the 6s or maybe even the 7s, and you can make it work, you can make it cash flow. And then you can also take advantage of rent growth in that market. You can take advantage of bringing rents to market. Maybe there's some efficiencies on the expense side, and you can make it work at a higher interest rate. That loan will reset, or it won't. Or maybe in 3 years, you go back to the bank and say, rates are in the 4s now. So if you can make it work at a higher interest rate at a lower price, and then you can drive the value up through forced appreciation, you're going to create millions of dollars in equity, and you're going to be in a really good spot when maybe rates compress down a little bit, when things get a little frothier again. And so this is where people make a lot of money. We know several multi-millionaires that made it when they started buying in 2012, 2010. I mean, Gabe, you're one of them. So yeah, I mean, it's not time to market, but it's know what levers to pull when you're at different macroeconomic cycles.